Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta, and the champion that we are starting today is the commodity sugar. It has seen a lot of volatile moves in the last year, and that continues for this year as well. The sugar prices in the previous year gained by something like 26% in the global markets, 35% in the Indian markets as well. And this year as well, when you look at the chart, the Indian markets really seem to be outperforming when it comes to the sugar prices as compared to what's happening in the global markets there. Well, of course, there have been various governments that seem to be intervening or are at a threshold of intervening when it comes to the sugar price rise to rein in the prices, of course. The Indian markets, we have seen the government actually talk to sugar commissioners, warn mills and stockists as well not to hold on to the stocks. In the other markets, we have seen UAE, China and Thailand, Brazil all try to increase production, be able to import more sugar so as to be able to control the sugar prices, which have been running high across board in the market there. But joining us to talk more about that is Mr. Narendra Murkumbi, who is Vice Chairman and MD at Sri Renuka Sugars. Mr. Murkumbi, it's such a pleasure to have you. It has been quite a supply-demand mismatch that we have seen every year, but we really seem to be moving from deficit to deficit. This year especially, with the kind of numbers that the industry is working out with, does look like that this season as well is looking at deficit. What's your own sense? What kind of a number are we looking at?
So I think in India we definitely have a very pronounced effect of the drought of last year on the current crop which is being harvested. And Karnataka, which is the third largest state, is already closed in terms, all the mills are closed. Maharashtra also, only 20 mills are operating out of the total of 150 or so that started operations. So virtually even Maharashtra is closed. And I would say with a great deal of confidence that the final production number for India is only going to be around 20 million at the most. And given that our consumption last year was 25 million and, we have a very big supply-demand deficit in India.
Mr. Murkumbi, how do you see the industry or the government? Do you anticipate a step being taken then to address this deficit?
Well, it's our strong belief that will have to be an import window. I don't think stocks are sufficient to get through to the next season. And this is a fairly good environment to start imports because while the Indian market is very tight, globally I think the consensus is building that after 2 successive years of deficit, we are going to have a small surplus on the world market in the coming year, that is 2017. You've already seen that prices which had been at a high of 24 cents in last October 2016 have now moderated and they are around the 20-cent area. And I think right now, all the northern hemisphere crops, the numbers are fairly well known. 2017-18 sugar season seems to be, as I said, in a small surplus. And the only risk, of course, is the oncoming weather risk in both in Brazil and in Asia in the next monsoon. But until then, the price environment globally is pretty benign and should be range bound.
As the data shows, the key sugar producing nations are taking steps to address the demand-supply mismatch. You have UAE now waving off or taking back the restriction of production there. We've also seen Thailand come out with some steps. Indonesia has been working towards it as well. China perhaps is looking at 6.5 million tons of a deficit this time around. Do you see any strong measures being taken by the Indian government as well, apart from the warnings that we've seen coming from them?
I don't have any knowledge of any steps, but as I said, I believe it is quite urgently required.
Do you see the 40% import duty go away? Because that is something that the industry is talking about right now.
Manisha, what I said is given that the steep fall in production and given the very tight supply position in the rest of the year, it is a natural market behavior that once the mills stop crushing, prices will start moving up. They already moved up significantly since the end of December. And it is natural that the market will react to this supply-demand tightness, especially when no more production is happening and all the mills are closed, which is going to happen in the next 30 days. So what I believe is that imports are required. Whether it will happen or not, I don't want to speculate.
But that point apart, Mr. Murkumbi, there also are, investors talking about on how perhaps Indian imports are preempting themselves. We already have seen imports come into India. The exports have been delayed in that sense. Do you see, and of course, as Indian mills have been asking of 1 million tons of import with a staggered or later deferred exports coming in, do you see all of those things already in the making?
There are large flows into the country, just like in oil refining. India has also now become a major sugar refining hub. In fact, the collective export capacity at the port-based refineries in India is now more than in the Middle East. So we have actually supplanted the Middle East as the largest source of regional refining capacity in the Asian region. So those flows have nothing to do with the domestic market. They are imported under advance license and the equivalent quantities exported out. Of course, there is a time gap of a few months between the import of the raw material and the export of the finished product. Currently, government allows us to export, re-export product up to 6 months from the date of import of the raw material, which is more than sufficient for the normal processing cycle. And there is also a seasonal cycle. You need to buy more raw material when Brazil is producing, and most of the good quality raw material is available at that time, which is between April and December, and then you consume it in the off crop when Brazil is not producing. Okay. So beyond that, it has no effect on the Indian market. The Indian market currently has a 40% duty. That needs to come down for any imports to happen.
Absolutely. So one final question before we let you go, and this really is on the outlook, Mr. Murkumbi. What is your sense on where the prices really could be headed? A very vague answer will also do on that, but we already have seen a 6-year highs in the Indian markets. The Delhi wholesale prices hit a 60 rupees per kg as well. So with that kind of volatility and prices just waiting to move ahead, especially ahead of the summer season demand, how would you look at the next 3 to 6 months?
Well, it depends a lot on the trade policy of the government. If there are no imports, I think prices could rise substantially, and clearly they could cross previous highs. This is nothing about speculation. This is purely very simple market economics 101. Last year, there was enough stock, and just by introducing stock controls, etc., the situation could be kept under control and prices could be kept stable. I believe that buffer is not there. And all the predictions about next year are all based on a normal monsoon. We don't know today what is going to happen to next year's production. I can still say that in the peninsular part of India, there will be more cane next year, but it is still not going to be normal. It is still going to be lower than normal. We cannot really speculate about how much production can happen next year, other than saying that it is going to be more than this year. Whether it will be self-sufficient or not is too early to tell.
Well, absolutely.
So whatever we have to do to address the deficit, those steps have to be seen. Otherwise, as more mills start shutting down for the year, we will see a pressure on the price, upward pressure on the price.
Your point is very well taken. Just going by the numbers that we are dealing with right now, it does look like that the sugar prices will gain further from here, especially for the Indian markets there. Mr. Murkumbi, really appreciate you joining us and answering all our questions on sugar. But now let's move on to some good news as well for the commodity markets. The Security and Exchange Board of India is likely to give its approval for mutual funds to trade in commodity markets. The regulator is also in talks with RBI to allow institutional investors like banks and FPIs to trade in the segment. Here is SEBI Chairman UK Sinha speaking to reporters on the sidelines of the regulator's international conference on commodity derivatives.
The market feedback is that there are theoretically 3 alternatives, that the settlement should take place either in physical delivery, or it should take place in cash, so the difference is paid in cash, or it should be settled based on the price discovered on the futures market on that day. The consensus view is that we have to go for the third option. In the last board meeting of SEBI, we had taken a proposal that the SECC regulation should be amended so that we can launch. Our idea was to launch options very quickly. But a view emerged in that meeting that this needs further examination from the legal point of view, whether this requires an amendment of the SCRA or SEBI is competent to do it through change in regulation. Among all the institutional investors, mutual funds will be the first one to get into that area, allowing banks to get into the commodities market. our argument with RBI has been that in any case, banks have huge exposure to commodities through their lending program. We have been asking them, why don't you start disclosing that? Let a beginning be made by corporates disclosing that. And then you will yourself discover that there is need to allow them to hedge also. So that we are at the earliest stage of a dialogue.
All right, so price discovery and of course getting farmers into the commodity markets and options being delivered or rather settled in physical delivery are the few points that the SEBI chairman of course seems to be talking about. But now it's time for a quick break. On the other side, we will discuss what's brewing in the tea space with Kamal Baheti of McLeod Russell, and also joining us will be Mr. D.P. Maheshwari, MD and CEO of Jayashree Tea Industries.